Well, hello everyone. Welcome to another edition of Tip Tuesday. This is Geoffrey Nance here with you, and glad to have you guys joining us for today's topic, which is building a diverse portfolio. Now, that may seem a little strange to hear that coming from us because we don't focus much at all on diversity as far as stock trading is concerned. And so what would be the point of that? Who would need today's lesson? So generally speaking, most people have a couple of different mindsets. They have a general buy and hold mindset, where they have stock that they bought a long time ago, or it could be company stock that they've held on to, or just something that they just felt connected to, or maybe it was passed down to them from their parents or grandparents, and this is a stock they've just been holding, for a while, and nobody has any real plans to do anything with it. They just sit there and watch it. And our family has a stock that's kind of like that. That's been in our family for a couple of generations, and they just pass it from one to the next. And at some point, it would make sense for somebody to either do more with it or sell it. But that's, maybe one stock here or there or something like that. So what does it really mean to have a diverse portfolio? So if you are actively trading, which is what we focus probably 90% of our efforts on doing, you can trade, basically any stock at any time. You're trying to align your stock with the movement of the market, but you can kind of trade anything that you want to with a plethora of strategies that we make available to you. So, what is the point then of having a diverse portfolio? When would I really use that? How would this really impact me? I would say there's a couple of things that you would want to consider. So let's talk about the short term first. If you are trading multiple stocks, even on a short term basis, it might be best to get stocks from different industry groups. So, in other words, if you're out there trading Halliburton, which is an oil and gas stock, maybe don't go trade ExxonMobil at the same time, because you're trading two stocks in a volatile industry. It's definitely based on news. So if you get some bad news at any point, it could drop that stock. Now, on the other hand, you say, Jeffrey, couldn't that also just like blow it up? It could, but that's not really diversified. So even just on a short-term scale, if you're trading multiple stocks at one time, it might be best to not have um, multiple stocks within the same industry group, because they could be impacted simultaneously. And again, that could be good or bad. So kind of moving that around, switching it out to a different industry group is probably ideal. Now, from a longer term perspective, if you are, let's just say, riding covered calls, and so you're planning on being in this stock for a year, maybe two, and you're going to ride this thing up. So let's just say we've gone through a bear market, and you want to go buy some stocks while they're cheap because you believe that they will increase. And historically, that has happened, that every time we've gone through a bear market, the market has recovered. And more often than not only has it recovered, but it's ended up going to a higher place than it was before the bear market started. So if you believe that that is a trend that is likely to continue, then you might want to go out there and buy multiple different stocks. And if that is the case, then spread them out over a variety of industries. And as you do that, you might be thinking, well, Jeffrey, I don't even know, what different industry groups are or how to think through that. Is one better than another, that kind of thing. And what I would say is, um, you don't have to focus so much on that. Now, there are leading stocks, there are certain industries that are going to be better than others, that are going to increase more over time than others. And I'm going to share something from Charts by Tradeway with you guys, just in case you're wondering, what's really out there. What can I trade? What are the different industry groups? So what I've done is I've gone over here to the watch. All right, fine. So go to find. All right, I just had to switch it over to watch list so we could go to a different place. So go over here to this little kind of lightning bolt, and you've got scan, screeners, What we're going to do is we're going to click on heat map here. And we click on heat map. You can change this. I've got the S&P 500. That's where I would go. But it does list off your major categories here. So not only does it list off the categories, but it also tells you those companies that fall within those categories. So a very, very great resource here for kind of walking through and seeing, okay, so what are the different categories? What stocks are included in those categories? So as I'm planning on diversifying, maybe I get something in technology, certainly. Maybe I go with something in finance. Maybe I get some industrials, maybe some aerospace and defensive stocks, maybe some healthcare, consumer discretionary. Maybe there's an opportunity there. Now these aren't going to tend, particularly vehicles. They don't tend to move as big, so that they're not going to be quite as big of movers. They're not, you're not going to find many vehicle stocks that are what we would call growth stocks. Now I know Tesla's kind of been all over the place and been on quite the wild ride, but in general, your vehicles aren't your major growth stocks. Restaurants and bars, lodging and leisure. Again, not necessarily what you would consider to be significant growth stocks. You might find a restaurant here and there, but for the most part, those aren't going to be growth stocks. Then you have your energy. You wouldn't necessarily expect to see these as growth stocks either, but here's your Exxon Mobil, your Hess, your Halliburton, your PXD. So all of these are your oil and gas stocks. Now, obviously, these are great to have. When oil and gas moves, it tends to move in a very nice pattern. It can make some really nice moves very quickly. So it's good to have. But one of the things that you'll notice is when you look at the energy list today, lots of red, which means it's down, anywhere from 0 to 3% today. And a lot of these stocks are in that category early this morning. All right, then you've got your consumer staples. Again, not going to expect a lot of growth here. But when I say that, guys, I don't want you to hear, oh, it's not a growth stock, so it's not going to grow in a new bull market. Any company that's any good is going to grow in a new bull market, and it may even move up significantly, but maybe not to the extent that something else would in a different industry group where it has more growth potential. All right. But again, your Walmart. So if we go through a bear market, it's a sustained bear market. Let's say it lasts 6 to 9 months. I mean, Walmart is going to drop in its price too. But as people start to figure out how to adjust to having less money and maybe being a little bit wiser with their money, and then maybe, actually saving up some money, and then they can't help it, they'll go start to spend it. Then Walmart and everything else like that would recover. Walmart's going to be a little bit more stable than something that's a little bit more of what we would call a discretionary stock, where I don't really have to have it. And if I have to pick, I'll just go without it. So some of those things are going to take, bigger hits, bigger percentage hits than, something that we're still going to keep. I'm still going to go to Walmart, right? I might buy less stuff. I'm still going to go to Walmart. Then you've got your aerospace, real estate, materials. So a bunch of different opportunities to choose from. And what we would say is, it's up to you. You say, well, how many stocks is a good number to have? Well, ultimately, that's up to you. It could be 3, it could be 4. If you feel like it, it could be more. I don't like to get too much more than that, but again, that's up to you as an individual. But definitely, if you're going to get out to 3 or 4, pick these different industry groups and get one stock from each one. So when it comes to picking a diversified portfolio, another thing to consider, and this has to be a reality, is some stocks cost more than others. So, what we're trying to do is put equal dollar amounts into each of our sectors. So in other words, Google costs a lot more than, say, Ford, so if you wanted to go with Ford. All right, so how do I correctly diversify according to the Tradeway system? Well, you don't get equal shares, because equal shares would give you a lot more shares of Ford, equal shares would be the same amount, but Google would cost you a lot more than it would to buy an equal amount of shares in Ford. So what we're going to do is buy an equal dollar amount. So let's say I've got $10,000 I'm going to put into Google. I got $10,000 I'm going to put it into Ford. I got $10,000 I'll put it into, Apple. I got $10,000 I'll put it into, let's see, oil and gas. Let's just go with we've been talking about Halliburton. We'll go with Halliburton. Okay. So I would spread that out. So equal dollar amounts spread out over different industry groups. All right. That would create a diversified portfolio. But we're not also not necessarily into this idea that we're going to, go buy something that's going to do better when the other thing that we're in is going to fail. Some people do that. And that is a way to approach that, where you can say, okay, generally speaking, if the dollar goes up, then, gold and silver does this, that kind of thing. We're not really looking for that direct correlation where if one of our stocks goes up, the other one's going to go down. Though if you wanted to think through that and really kind of consider, okay, well, how can I really truly be diversified? A lot of mutual funds do have that kind of ideology behind that, where they pick stocks where they know where if this one's doing well, that one won't do well, but they'll balance each other out. So certainly that could be a consideration for you if you're really trying to go all in on the diversification thing. Then that's something that you could consider as well. So we're looking at equal dollar amounts. It'll be different amounts of shares. Now, some people might be out there thinking, well, you're talking about buying the stock. Would I take the same approach with buying options? And yes, if your goal is to be diversified, then you would take a similar approach with options. All right. Now, if you find that there's a particular space and time where a particular industry group is in a very clear pattern, is it okay to go out there and buy multiple different stocks? Could I go buy JPM and Citigroup or whatever? Yeah, you can, right? For a specified amount of time, for short periods of time, that's okay, especially if they're really aligned in a very clear pattern. You go, hey, this industry is doing really well. That makes sense. Let's go hop in. That's certainly something you can do. But when we talk about diversification over a long period of time, then you would want one from each one. And by the way, on that topic, what if I really, really, really do want to do JP Morgan Chase and Wells Fargo? Can I do that? I know they're both in the same industry group, but can I get stock in both of them? If you were to do that, what we would say is, okay, cool. You were going to put $10,000 in each one. Well, don't do that now. You've got two in the same industry group. Put 5,000 in JP Morgan Chase, put 5,000 in Wells Fargo. Now you're at least a little bit more diversified there, where you still are spreading out. So it's the same $10,000, but since we're dealing in the same industry group, we're only going to put $10,000 into that industry group. So we're going to diversify. We can have multiple stocks in the same industry, but we're going to divvy up our money in order to keep that balance there. And again, you would still say, okay, so $10,000, still spread it out. Go put you some money into some other different industry groups to finish your diversification there. All right, guys. So thanks for being on with us this morning for another edition of Tip Tuesday. Appreciate you guys joining us each time. Thanks for being a part of today's discussion on building a diversified portfolio. And we will see you next time.